This is exactly how we at Disrupt Equity underwrite deals, analyze real estate opportunities in 2023. Welcome back to Money Mondays, folks, where we put new content out every week, whether it be real estate investing or business strategies or partnerships or technology, where we're trying to put out content and new videos so you guys have the tools and the tricks and the strategies so you can go out and do your own deals in 2023. Or if you don't want to do all the hard work, you can invest with us as well. We've done over $700 million in real estate. We have over 4,500 units that are currently under management, where we have been able to provide net to investors 30 to 50% average annualized returns. So you're looking to invest in 2023, then stick with us and learn how to analyze potential deals in this video, where we're gonna go through financing, what type of properties you should look at, what are some of the market trends that you should be looking at when you're looking at various markets, and ultimately, how do you do the analysis to make sure that you're buying the right opportunities in this new year. So whether you're a first-time investor, you're a seasoned pro, this video will ultimately allow you to walk away with some more tips and strategies in how do you buy your right deal. So grab a cup of coffee and let's dive right into this. So let's talk about the market, right? You have a macroeconomic market and you have a micro sub-market that you're actually looking at. So when we're looking at the macro market, we're looking, are we in a recession? Is there inflation happening? Are interest rates going up? And how does that all affect the debt or the loan that you might get on the property? Because a lot of this, you have to take that into consideration when you're getting a loan. But there's the micro sub-market part of it, because what do they always say about real estate? It's a very local, hyper-local in some cases, so you have to take that into consideration. So then you look at the sub-markets that you're looking at. Are those sub-markets growing? Is there population growth? Is there job growth, right? Are jobs moving there? Are Fortune 500 companies or people's headquarters moving into those markets? You know, we're right here in Texas. We see that all the time. It's constantly making the news. And so you need to understand that. You need to understand, even at a more basic sub-market level, is there crime in that area? Are the school districts and the schools in that area great? Is there new development happening in that subdivision? All of those things will allow you to have a good sub-market and macro market look at, am I investing in the right markets and at the right time? All right, so once you've kind of picked the markets that you want, where your buy box is, we talk about this all the time on this show, now you can start kind of looking at property by property specifics. You know, what is the sales price of the deal that you're looking at? What is that in comparison to the cap rates that are in that market? Is it a 7 cap and everything else is at an 8, which means that it's a more expensive property, or vice versa? Maybe you're getting a 7 cap, but everything else is at a 5. That might mean that you're getting a good deal. What's the inventory? Is there a lot of things that are trading or selling in that area, right? And so you need to understand that. You know, I think that that's important, you know, and then ultimately, what's the rent growth in that market, right? Because the rent growth is really driven by supply and demand, folks. When you boil down multifamily syndication, what exactly are we trying to do, right? We are trying to play into supply and demand, you know, imbalances in the market. If there is a lot of people that are demanding rental products, and there's not a lot of supply, then we can push rents, right? And so I think that that's important too. And then it's also important to understand that from a buyer's and a seller's perspective. If there's a ton of demand, but there's not a lot of supply, the price is gonna go up. And then inverse to that, if there's a lot of supply and not a lot of demand, the price is going to go down. And this happens not only on multifamily and commercial and residential, that's just a real estate thing in general, right? But if you're looking to evaluate the property, you need to take those things into consideration. So once you've determined what market you want to be in, now you've looked at the properties and some of the ones that you want to look at, you got to make sure that the numbers work, right? So you got to crunch the numbers, you've got to analyze your deal, you've got to underwrite your deal. All of those things are synonymous, right? So when people are like, well, what does underwriting a deal mean? It means we were taking historical financials, we're plugging them into our underwriting model, and then we are projecting out typically 3, 5, maybe even upwards of 10 years, how we could operate the property, right? And from there, you can start determining, you know, what kind of returns you're gonna get, you know, and people are like, well, what is a good return and what type of returns are we looking at? Look at cash on cash, right? So if you put in an investment of $100,000 into a project and it pays you $10,000 a year, That's a 10% cash on cash return, right? So that's probably the most important metric that people should be looking at because, why did we get into real estate in the first place? It's cash flow. So you want to make sure that cash on cash is higher, is always better. But right now you're probably in that 6 to 8% return range. Okay, so some of the other things that we look at is average annualized return, total return, as well as IRR, all of which are important. And again, the rules of thumb vary. It just depends on the market and the type of vintage that you're looking at. But if you're looking at average annualized returns, 15 to 20%, total return, typically over a 5 to 7 year period, we like to see that at 100%. That means it's a 2x equity multiple, another metric that you should be looking at as well. And then on an IRR basis, anywhere from 13 to 17% is pretty much where market is right now on kind of the class B and A minus stuff that we tend to look at. Those are some of the metrics that you should be looking at and really the boxes that you should be looking to make sure that your property falls into to see if it's a good deal or not. So now that you've found a property that's cash on cash and average annualized returns, all of those hit your investment projections that you're trying to hit for you and your investors. Now you got to start looking at your financing options, right? So if you're looking at typically 100 units and above, which is where we're looking at, and if you're probably tuning into my show, you're probably looking at the exact same one. You're going to be looking at a couple different options, right? You're looking at either a Fannie and Freddie permanent loan, because Fannie and Freddie could do 3 to 20-year options, or you're looking at a bridge loan. Now, what's the difference between the two? And I'm going to drill it down really, really quickly for you. A bridge loan is on something that needs a little bit more love, right? Maybe the occupancy is not as high as it should be. Maybe there's a lot of work that has to happen on it. And so Fannie and Freddie tend to stay away from those less stabilized properties. And so now you got to go with a bridge loan. Now you're going to say, well, what are you getting on bridge loans these days? It's typically anywhere from 8 to upwards of 10% now. Last year, even 18 months ago, it was probably half that, but that's where it is currently. And leverage, you're going to get probably upwards of maybe 60 to 70% leverage. And when I mean leverage, that means your loan to value or your loan to cost, right? So if you're paying $10 million for the property, you might get upwards of $6 million as a loan to value loan, right? So you got to take that into consideration when you're underwriting. Now, if the property is a little bit more stabilized, a little bit nicer, occupancy's there, I would look at Fannie or Freddie. Fannie Mae and Freddie Mac are essentially pseudo-government entities that provide liquidity and provide loans into the market. And those are going to be, given on behalf of other lenders. And so it's important to understand that you're not going to get a loan directly from Freddie Mac. They just provide the liquidity to the lender and then the lender gives you the loan. Bottom line, if you have, say, a property that's in a nicer area, it's 95% occupied, I'd go back and get maybe a Freddie Mac loan. And again, they can provide permanent loans. They can provide variable loans where they fluctuate just like the bridge loans. And just one thing to mention is it's a variable rate. You have to have an interest rate cap. Whereas on the permanent loans, you can also get a fixed rate. The fixed rates right now, probably close to 6. Maybe you can, in certain markets, you can get 5.5. So 5.5 to 6 is probably where you're going to be at right now. Whereas the leverage is going to be a little bit lower, right? So you're probably in that 50 to 60%. And that again is the loan to value. So when you're thinking about which option is better, you need to determine, again, is the occupancy below 90%? Is it below 80%? And in that case, definitely want to go with the bridge loan. Does the property need a lot of work? If the property needs a lot of work and you're going to put a lot of money into it to improve the property, a bridge loan might still be a better option for you. Now, if it's a little bit more stabilized, you want to hold on to the property for a little bit longer, going with the Fannie and Freddie product is also going to be a better option. But those are typically your 2 buckets of money when you're talking about 100 units plus in our business, right? Bridge loans, Fannie and Freddie permanent loans. So once you've determined which financing options you want to put onto the property, now you have to kind of talk about some of the other various aspects of how you're going to put the deal together. And so some of the things that we always try to look at is where are we going to get the best insurance, right? Who is the best property management company for the property? Who is a good general contractor, right? So you want to determine who your team's going to be and build that team out way ahead of time, right? Because you got to have to ultimately validate how you underwrote the property. Was my insurance, on track? Was it good? Was it high? Was it low? Right? And only an insurance agent or insurance broker can really help you determine that. You want to validate some of your operating expenses and your operating revenues, right, with a property management company. You're going to want to validate how much money you need to put into these properties through a general contractor. All of these people can help you dial in your financial underwriting. Then the other way that you're gonna have to do it is once you're under contract, right, you're gonna wanna get onto the property, you're gonna wanna do your physical due diligence, right? So up to this point, you were doing financial due diligence, right? You were reviewing the T12s, you were reviewing the rent rolls, you were doing your assumptions and your financial projections. Now you're popping the hood, right? You're seeing if there's any skeletons in the closet. And the only way you can do that is you're gonna go a unit by unit walk to make sure that what the seller was telling you about the property's condition is correct. What the seller was telling you about the property's occupancy was correct. You're validating these last few pieces of information in order to make sure that whatever you thought upstream was this was a good property, it's in a good area, is now been validated by these various third parties and through your own eyes and being on site and doing your unit by unit walks. The last thing that we always tell people too is make sure that you're underwriting with a fair amount of reserves. There is some uncertainty in the market right now, folks. Inflation is still here. Our interest rate's gonna go up, right? And ultimately inflation leads to inflationary expenses, and I guess inflationary prices for a lot of different things, right? Whether it be payroll, whether it be appliances, whether it be, just your contractors in general, all of that stuff has gone up quite a bit. We don't think that it's gonna go up as much in the future, but it's gone up quite a bit. So what you thought you could get that appliance package for 12 to 18 months ago is probably not the same thing. How do you mitigate that, right? How do you mitigate that risk? It's by having enough reserves on the property in order to support any fluctuations in the market, fluctuations in things that need to get paid for, just anything in general. It's a rainy day fund for a reason. It allows you to sleep better at night, allows your investors to sleep better at night, and really it doesn't really depress or water down the returns all that much. Typically what we do, a minimum of 5 to 10% of the capital raise. So if we're raising $10 million, 500 to $1 million of that minimum is going to be reserves. Sometimes it could be upwards of 20% too, right? Just depends on where's the asset located at, what condition is it in. If it's in a little bit rougher condition, I would probably say have some more rainy day funds in there. And then ultimately, this can also be used as a contingency fund for your CapEx too, right? So not only have things gone up a little bit more in price, you start popping open things and you start fixing things and other things sometimes break. It's just inevitable. I've done $25 million in rehab at this point in my career. And I can tell you without a doubt that every single time that we've done that, there's been at least something that's popped up that was unforeseen, even through the due diligence process, and we had to pay for it. So having that, set aside again as a contingency is always a good thing. So remember folks, in real estate investing is a long-term game. It's not a get-rich-quick scheme. Yes, you can become wealthy, but it takes time. So it's important to have a long-term approach. Make sure you do your due diligence. Make sure you have a great team. Make sure you've double-checked your numbers. It's important that you take this approach because ultimately, if you want to be in this game for the next 5, 10, 20 years, you don't want 1 or 2 deals to torpedo that, right? So we hope you found this video helpful and informative, and we wish you the best of luck navigating through this tumultuous time in 2023 and beyond in real estate. So leave us a comment or ask us a question. We'd love to hear from you on what our next topic should be. Me and Ferris love to make this a little bit more interactive. So we'll see you on our next Money Mondays, and we really appreciate you for tuning in.